Our economy is really being put to the test right now. I mean, in 2020 and 2021, our government printed trillions of dollars, which diluted the value of our money, which has caused more inflation to happen, which is why the cost of everything has skyrocketed. The price of groceries have gone up, the price of housing has skyrocketed, the price of lumber has gone up, and now on top of that, people are not going back to work. Companies and businesses are struggling to find work to help grow the economy, and so a lot of people are wondering now, what's going to happen to our economy next? Is our economy going to continue growing, or is our economy going to slow down, and are we going to enter a recession 2.0? What's up, everybody? I am Jaspreet Singh from theMinorityMindset.com, where money minds rethink rich. Our economy between 2020 and 2021 has been through an emotional roller coaster. Back in the early part of 2020, our economy was booming and the market was booming. Back in February of 2020, the Dow Jones broke a new record at right around 29,000 points. That was the Dow. And at the same time, our unemployment rate back in February of 2020 was 3.8%. So the economy, at least on paper, was booming. Then came March. And as we all know, that was when the pandemic hit and everything changed. In March, the Dow Jones went from 29,000 points in February all the way down to right around 19,000 points in March. And that was when Donald Trump signed the $2.2 trillion CARES Act into law, which sent out the first round of $1,200 stimulus check to people. It bailed out a bunch of corporations, and it tried to help save the economy because our economy was in free fall. You saw that with the stock market because we were at 29,000 in February and the Dow came down to 19,000 in March. Then came April, which was when the entire economy shut down. Nobody knew what was going on with this pandemic. Nobody knew how serious it was. Nobody knew really kind of what was going on in the world. And so our entire economy shut down. And so the unemployment rate in April shot up from 3.8% in February all the way to 15% in April 2020. In July, things started to recover a little bit. The unemployment rate came down to right around 10.2%. Now, a 10% unemployment rate is absurdly high. That still meant that 1 in 10 people in the United States did not have a job. And so we still had a very high unemployment rate, but it's better than what we had in March and April. And so July, things started to recover a little bit. And in July, that was also when the $600 benefit, unemployment benefit from the government started to fade away. If you remember back when the CARES Act was passed, one of the things that this CARES Act did was it gave people who lost their job in this pandemic an additional $600 a week from the federal government. So if you lost your job, you could go file for unemployment and the state would give you your regular unemployment benefits and the federal government would give you an additional $600 a week on top of your state benefits. And that started to fade away in July. And so we still had millions of Americans unemployed, but it was a lot better than it was just a couple months ago. July was also when the housing market really started to pick up steam because when this recession hit around April, the Federal Reserve Bank slashed interest rates to near zero, and so mortgage rates came crashing down. And it wasn't until June or July when people really started to see that, oh wow, I can take advantage of these cheap mortgage rates. So around June and July, people started going out and buying homes in droves, and we had a very small inventory of homes available for sale. So home prices really started to go up in July. And then in the end of 2020, in December of 2020, we saw unemployment rates come down all the way to 6.7%. So still a very high unemployment rate. We still have millions of Americans out of a job, but it's a lot better than what it was just 6 months ago. December was a really fun month because not only did we see unemployment rates come down to 6.7%, but the stock market also broke new highs. So in February 2020, the Dow Jones hit 29,000, which was a high. And then in December 2020, the Dow Jones crossed 30,000 points. So not only did we beat our February high, which was the highest high that we ever had before, but December broke a brand new stock market high when the Dow Jones passed 30,000 points. And December was also when President Donald Trump passed the $900 billion stimulus bill, which sent out $600 checks to Americans. This brings me to 2021. So let me draw a brand new line here because 2021 has been a very interesting year to say the least. So starting off in February, the unemployment rate came down to right around 6.2%. Then in March, we saw the unemployment rate come down to 6%. And this was when President Joe Biden came out and he passed the $1.9 trillion stimulus bill, which put another $1,400 stimulus checks into the hands of Americans, and it had other provisions in there which gave money to other businesses and other industries. So another multi-trillion-dollar stimulus bill that was passed, and this put more money into the hands of Americans. And then came April, because in April 2021, the unemployment rate went from 6% up to 6.1%. The reason why this is so interesting is because if you look at the charts, back in March and April, we had an extremely high unemployment rate at 15%. From April to December, we went down all the way to 6.7%. From December to March, we went from 6.7% to 6%. So you can see that the unemployment rate kind of has stabilized. It didn't really go down too much more. But between March and April, this was the first time that we saw unemployment rates start to go up. And another thing that happened in this 2021 is we really started to feel the effects of all this money printing. Because when you print so much money, the value of our dollars get diluted. If you've been subscribed to our YouTube channel, you know how money printing works. The whole idea behind money printing is the government doesn't have these trillions of dollars sitting around somewhere, so they have to print this money, and as you print more money, the value of each individual dollar that you have goes down, which makes the cost of everything else go up. That's why in 2021, we've been seeing home prices skyrocket, we've been seeing grocery prices skyrocket, we've been seeing flight costs skyrocket, and so the cost of living has really been going up in 2021, while at the same time, people are not going back to work. Now, there's a few reasons for this. One of the reasons is the government is still giving people a lot of money at the time we're recording this video if you are in unemployment, and so a lot of businesses just cannot compete with the unemployment benefits. The second reason is some people are scared of getting sick. They don't want to go back to work and risk getting sick and taking this virus back home because this pandemic is still here. And so because of these issues, our economy is still struggling, and at the same time we have printed so much money, and now people are worried. What's going to happen with our economy, because asset prices have been extremely volatile. Like if you look at cryptocurrency, we saw cryptocurrency breaking brand new highs in 2021, and then we also saw cryptocurrency come crashing down in 2021. The same with the stock market. The stock market broke brand new highs in 2021, and we've also seen major swings in the stock market going up and down. And the housing market has really just been skyrocketing, and this has people worried about what's going to happen in the housing market, because the housing prices have been going up like this, even though wages have not been keeping up. And so people are worried that the housing market is going to outprice people, and if that happens, people are not going to be able to afford housing anymore. So the question is now, what is coming next? And that's what I'm going to be talking about in this video. But before I get into that, I need you to do me a quick favor and smash that thumbs up button below. By the way, if you didn't know, we have just launched our very own free minority mindset community. We call it the Guac Talk community because we talk about all things minority mindset, from the stock market to the real estate market to cryptocurrency to money management to how you can build wealth. Our community is hosted on Discord and is completely free. So if you want to join our free Guac Talk community and chat with other minority mindset thinkers, I got the link to how you can do that in the description below. So if you really want to understand what's going on and get a better idea what's coming, there's a few things that you need to understand. First, you got to understand how our economic system works and how our economy works. Second, you got to know where's all this extra money coming from, because you've probably been seeing a lot of people spending a lot of money. So you want to know where this money is coming from, and you also want to know what is the cost of this money, because all this money isn't just stimulus money and it's not just unemployment money. So you want to know where this money is coming from, and you want to know the cost of this new money that's been printed and created in our system and what this is going to do in the future. Then you want to know what's going on with all this debt that we've been racking up and all the speculation that you've been seeing in asset prices. Once you understand that, we can talk about what's potentially coming in the future. So this is what we're going to be talking about, and let's start with number one. Our economic system is fueled by one thing: spending. Businesses create things and people buy things. The more things that people buy, the more money businesses make, and the more money that businesses have to grow, hire more people, and create more jobs. As more jobs are created, more people have money, and more people have more money to spend. So if we break it down a little bit deeper, let's assume that you have $100 in your pocket. If you have $100 in your pocket, it's not really doing anything for the economy. I mean, it's money that you have saved, and it's money that you can use, but if it's just sitting in your pocket, that money isn't doing anything for the economy. But now, let's say you go to the mall, and you go to your favorite store, and you take this $100 and you go spend it in the store. Now, you got something. Let's assume that you bought some guacamole, some very expensive guacamole, but you got $100 worth of guacamole. You got a product, and now this business just made $100. because this business just made some money, now they have money to pay their employees, they have money to keep the lights on, they have money to pay their rent, and if they have a lot of people shopping there, they have money to open a second branch. If they open a second branch, they're going to have to hire another cashier, they're going to have to hire more people to make their guacamole, and so they'll be able to create more jobs. If they create more jobs, more people have an income stream, and more people have money to go out and buy rent somewhere, more people have money to go out and buy another car, more people have money to go out and go shopping, and so this helps fuel the economy. The more money that people spend, the more money the economy has, and the more the economy can grow and more people that have jobs that can ultimately support the economy even more. Now, don't get me wrong, I'm not saying that you need to go and spend every dollar that you save and spend every dollar that you earn for the sake of our economy to be a good American patriot. That's not what I'm saying. It is not your American patriot duty to be broke for the sake of the economy. I'm just saying this is how the system works, okay? So the more money that people spend, the more our economy grows. But the thing that makes the system so interesting is that we live in a credit-based society, which means people spend money not based off of how much money they have in the bank, but based off of how much credit they can qualify for. So we have two types of money in the system. We have actual money. This is the money that you make from your job. And then we also have credit. So if you make $10,000, you might be able to spend $20,000 thanks to the help of credit cards and lines of credit and loans. And so in our economic system, money and credit work the exact same way. Because now if you go to the guacamole store and you have a credit card, and now you don't have $100 in the bank, but you got a credit card with a line of credit, you can spend $100 even though you don't have $100. Now, to the guacamole business, it makes no difference if you're spending money or credit, because money and credit in the system, the economic system, work the exact same way. The business doesn't know if you're spending this or this, they're just getting $100. After you spend the money, then it's going to be your job to pay this money back plus interest. But in the economic system, the more money and credit that there is in the system, the more dollars that there are floating around, and the faster that our economy can grow. Because if our system only lived off of money, now people might be financially smarter, but we're focusing just on the economic system. If our economy relied only on money, then there'd be way less dollars in the system and people would have way less buying power, which means people wouldn't be able to afford as nice of apartments. People wouldn't be able to afford as many cars. They wouldn't be able to buy as many clothes. They wouldn't be able to go on as many trips. And if that was the case, then you would see the whole economy shrink because businesses wouldn't be making as much money. Now, when you add credit into the system, now all of a sudden somebody who has $10,000 can go out and spend $20,000. So now you can go out and buy even more guacamole, you can go on even more vacations, you can buy more clothes, you can buy a nicer apartment, and so now people have more money in the economic system. The thing that I want you to understand about this now is when we start to go into a slowing economy, people start to lose their jobs. Like we saw happen in 2020 and 2021, we saw unemployment rates go up. So when people lose their jobs, not only do they lose this, but now people become less credit worthy. And so now you lose a big chunk of the economy here because now people lose the ability to qualify for money. And so people have to spend based off of this. And most Americans don't have a lot of this because people live in a credit-based society where people spend based off of how much they can qualify for, not how much they have. And so when we enter a recession, it really becomes a big problem because we lose a lot of dollars in circulation because our credit system starts to crumble. So if we're diagramming this out, what happened was people started to lose their jobs. This money started to go down and this credit started to disappear because when you don't have an income, you are no longer credit worthy. So we saw this go down significantly and this also went down. That's when in 2020 and 2021, the government worked with the Federal Reserve Bank to pass these stimulus programs that I talked about just a minute ago. So we saw trillions of dollars printed by the government and the Federal Reserve Bank, and this money was injected into the economy. So I'll put this in a different color. So this money was injected into the economy, and this was given in the form of stimulus checks, unemployment benefits, bailouts, and a whole bunch of other government programs. So the government increased the money supply in the system. And so the initial worry that everyone had was the government is printing so much money and is throwing it into the system, we are going to see massive inflation. And if you've been subscribed to our YouTube channel, we talked about that. In the beginning, that wasn't a concern because there was no credit. So the amount of dollars in the system were actually decreasing. And so the government and the Federal Reserve Bank were trying to fight deflation because we saw credit disappear, so the dollars in the system started to disappear. And so to fight that, the government and the Federal Reserve Bank started increasing the money supply, and this was just balancing out this. So in the beginning, we didn't have to worry about inflation. We were trying to fight off deflation because we were losing this, and the increased money printing was just balancing this off. and we weren't worrying about this. The concern that we talked about in 2020 and early 2021 is what happens when people start to get their jobs back, and now we have a much bigger money supply and credit starts to return. Well, that's what we're seeing right now. This brings me to the second thing that I wanted to talk about. Where is all the money coming from? So let's talk about this, then we'll talk about this. So the government and the Federal Reserve Bank work to create trillions of dollars out of thin air because the government doesn't have trillions of dollars sitting around in a vault somewhere. Our United States government is drowning in debt. So when they wanted to spend money that they didn't have through the form of the stimulus plans, they had to essentially create this money out of thin air. So they worked with the Federal Reserve Bank to print this money, and the Federal Reserve Bank printed this money and they gave it to the United States government, and then they injected it into the economy through the form of unemployment benefits, stimulus checks, bailouts, and other government programs. So this money was injected into the economy, and some people started to make a whole lot of money. What we saw happen was that some people were disproportionately benefited by this pandemic, while other people were really hurt by this pandemic. So this was what you call a K-shaped recovery, because some people really saw a benefit while other people were hurt. Like I was at the granite store not too long ago, and I was talking to one of the salespeople, and what he was telling me is that their business has been booming, and some of their workers worked through the entire pandemic. They took like 10 weeks off, and during those 10 weeks in 2020, everybody was getting these unemployment benefits with a $600 weekly additional bonus from the federal government. So nobody lost in income. Those 10 weeks, people were on unemployment, and then everybody came back to work, and then on top of that, everybody was making the regular paycheck plus stimulus checks from the government. One of the guys that I was talking to, he did not lose an income throughout the entire pandemic, and he also made an additional $14,000 through stimulus checks from the government. So that was $14,000 of free money that he got that he could spend. And so he didn't know what to do with that money, so he bought a lot of brand new stuff for his home. He bought new furniture and he bought new electronics. So you saw a massive increase in the money supply here thanks to the help of the government and the Federal Reserve Bank. And this disproportionately helped some people more than others, because people that really weren't hurt by this pandemic that much really got a big boost because they were getting extra checks from the government. And on the other side, people who were hurt by this pandemic were hopefully benefited through the help by the government. But we don't really know how well they were benefited or how well they were not benefited yet. We'll learn more about that in the coming months and the coming years. On the flip side of things, we also saw a lot of money created on the credit side of things, because if you are a homeowner, chances are you saw the equity in your home skyrocket between 2020 and 2021. So let's assume that you bought a home back in 2017 for $300,000, and in 2021 the value of your home went up to $360,000. Now, at this point in 2021, you might only owe $280,000 in your mortgage, but now the bank is calling you and saying, hey, how about you do a cash out refinance? You only owe us, so I'm gonna put this right here, I'll put it in red actually. So you owe $280,000, but we, the bank, are willing to give you a loan for $320,000 right now. And on top of that, if you take out a new $320,000 mortgage, your monthly payment will not change because mortgage rates have crashed. So now you're like, well, that's $40,000 I could put in my pocket right now. And yeah, I'll extend my mortgage by just a few years, but I'm getting $40,000 essentially for free because my mortgage payments are not going to change. So now what do? Is you take out a $320,000 cash out refinance, you pay off this original loan for $280,000, you keep $40,000 in your pocket, and your monthly payments do not change. So now you essentially just got a brand new $40,000 in your pocket that now you can use to spend however you want. This is brand new money that you created through credit, and many people have been doing this because we are seeing the highest levels of cash out refinancing in years. This cash out refinance boom is fueling this K-shaped recovery, because let's assume for a second that you're a homeowner and you didn't lose your job for more than 10 weeks during this pandemic. If that was the case, and let's assume that you have kids. If that's the case, now you never lost an income, because if you were unemployed for those 10 weeks, you were getting these big unemployment checks for the government, and then on top of that, you went back to work and you started getting paid like normal. Then if you have kids and you qualified for a stimulus check, the government was giving you check after check after check. You got 3 stimulus checks, and you get one for you, your spouse, and maybe even your kids, depending on if they qualify or not. So you might have gotten $10,000 worth of stimulus checks, and if you owned a home on top of that, you might have seen another $40,000 or $50,000 in equity that you may have cashed out of. So now you got $10,000 or $20,000 from the government for free, essentially. And on top of that, you also got another $50,000 from your cash out refinance, and your mortgage payments haven't stayed the same because you locked in a 2.8% mortgage for the next 30 years. So now you have $50,000 from your mortgage, you have another $10,000 in stimulus checks, and you got $60,000 in your pocket that you never had before. You were benefited by this pandemic. Now, obviously, yes, some people really hurt by it, but this is why I'm calling it a K-shaped recovery, because some people really benefited while some people really hurt. And now, if for the first time ever, you have $60,000 in your bank account, what are you gonna do? Well, you're gonna spend it. This brings me to number 3, understanding the cost of this system. Because now we have seen a lot of America have this newfound cash in their bank account, either from stimulus checks or from this newfound equity in their property, so from money and credit. And now people have been spending this money. Some people have been using this money to go out and buy a rental property, or to go out and buy a new home, or to go out and invest this money in the stock market. That's why you have been seeing asset prices booming, because not only is the value of our dollars dropping, but people have been using this cash to go out and buy assets. So you have seen people buying cryptocurrency, stocks, and real estate, and that's why you saw a massive boom in these prices in 2021. Now, I know you've seen a lot of volatility, but there's other reasons for that, and I'll get to that in a little bit. But you've been seeing a massive boom in these asset prices for a big chunk of 2021 because people have been using this newfound cash to buy assets. Another thing that you've been seeing is people have been using this newfound cash to go out and go shopping. If you go to the mall anytime after a stimulus check is passed, you see a lot of people standing in the Gucci line. Why? Because people got some new free cash, and when they have cash, they want to go out and spend it. Now, you might hate me for saying that because that sounds so rude, but the reality is that's actually exactly what the government wants, because they call it a stimulus check. But what they don't want you to do is to stimulate yourself. They want you to stimulate the economy. And if you remember what I said before, the way you stimulate the economy is not by taking this money and putting it in your pocket. It's not by taking this money and saving it. It's not by investing this money. If you want to stimulate the economy, the way you do that is by going out and going shopping. So when the government gives you free money, they want you to go out and blow this money, because now you are circulating this money in the system, which puts more money into businesses so they have more money to invest in their company, hire more people, grow, create more jobs. And so when you hear about people blowing the stimulus checks, that's exactly what the system wants. But now you got to understand, what is the actual cost of the system? Well, let me start with this. The most expensive kind of money is free money. Because when the government goes out and they have to print money through the help of the Federal Reserve Bank, they are borrowing this money and then they're giving it to people or to businesses. So they're injecting this money into the economy. But this money comes at a cost, because when the government prints this money, they have to pay it back plus interest, and there's a tax that you have to pay, which is not a tax you pay the government, which is called inflation. So let's start with the first thing, which is the government having to pay back this money. Here's a very rough representation of what's going on. So the Federal Reserve Bank prints this money and they loan it to the government, and then the government passes this money out to people. So let's say this is you. I'm gonna draw you with a nice mustache, or for our female followers, I'm gonna draw you right here with a beautiful braid, or as we like to call it in our native language, Punjabi, a gut. So the Federal Reserve Bank loans money to the government puts this into our system through stimulus checks, unemployment benefits, bailouts, whatever you want to call it. The money gets injected into our economy. Now, the government has to pay this money back to the Fed plus interest. Now, where does the government get their money? Because the government is not a for-profit entity. Well, the government makes money when you work hard at your job, because the government makes their money through taxes. So now you got this money, and every single day you're going out to work every single day, and then you are going to have to pay your fair share to the government in taxes. So now the government gets this tax revenue, and when they get this tax revenue, the whole idea is the government wants to improve your quality of life, because if you live in the United States, the government wants to give you nice things, right? Because they want you to live in the United States. But now the issue is the government has to pay more money back to the Federal Reserve Bank, because think of it like a credit card. If you went out and you swiped a whole bunch of money on your credit card and you couldn't afford your monthly payments, and then you went out and you bought a huge laptop and you bought a huge, Lululemon leggings, and you bought a bunch of nice things, now your credit card payments are going to go up because you have a bigger balance. Well, the same thing happens here. The government is going to have to spend more of their future tax revenue to pay back this money to the Federal Reserve Bank. So now for the next, I don't know how many years, the government is going to be paying back all this money that they printed in 2020 and 2021 plus interest, which means more of our tax dollars are going to be going to pay down this debt, which means there's going to be less money left over to improve our standard of living today, unless the government can raise our taxes. So if the government wants to keep their spending high, they're going to have to increase their tax revenue, which means increasing the taxes that you have to pay in order to fund all of these programs. So that's why you're hearing about tax rates potentially going up. The second cost that you have to pay is the hidden tax. It's called inflation. Because as more money is created, like we saw happen in 2020 and 2021, and this money enters our system, well, eventually you're going to hit a point where now you have a lot more money than there was before, because originally we were fighting deflation, but as credit comes back, now we have way more cash in our system. We have way more dollars in our system, which means the value of each dollar that you have, and the value of each dollar that you earn, and the value of each dollar that you save doesn't stretch as far because our buying power for our dollars has dropped. That's why the price of things keep going up. And so now you have to pay a hidden tax of inflation, because what inflation is when the value of our money drops, which makes the price of things go up. So now, not only is more of your money potentially going to be going to taxes, but the dollars that you do have are not going to stretch as far, because you have to also pay a hidden tax called inflation. Now, the way you combat this inflation is by using your money the right way. That way you can see your money grow with or faster than inflation by investing your money and having the right money management tools. I'm not going to get into that in this video, but if you are interested in learning more about that, our team put together an amazing guide on money management and investing that you can read for free when you sign up for a daily newsletter. So if you want to read this guide and learn more about money management and investing and how to use your money the right way, that way you can beat inflation, I got the link to how you can download our free PDF in the description below. So now that you understand how our economy works, and you understand where all this money has been coming from, and you understand the cost of all this money printing, now once you understand the debt and speculation side of things, that's when we can talk about what might be coming next, because you'll have a really good understanding of how this system is really working. So in the beginning of this video, I talked about how the Federal Reserve Bank slashed interest rates to stimulate the economy. The reason why they do that is because when they slash interest rates, borrowing money becomes cheaper, and when it's cheaper to go out and borrow money, people will go out and borrow more money, which creates more credit into the economy, which gives people more money to spend. Although it's not actual money, it's credit, but people have more dollars to spend. And so when the Federal Reserve Bank cut interest rates, you saw mortgage rates go down, and many people went out and they borrowed money. And when they used that, they went out to go buy a home, or they refinanced on their own home and pulled some equity out on their property. That way they had more money to spend or invest. And you also saw this debt grow on the stock market side of things, because many people started trading stocks for the first time, and they opened up these brokerage accounts, and many brokerage accounts give you easy access to margin or debt to trade money. So now you put $2,000 into your account, and now your brokerage is going to give you access to some easy margin on top of that. That way you can invest even more than $2,000. All you got to do is pay your brokerage a little bit of money, and if you can increase the amount of money you have invested, now you can make even bigger returns. But on the flip side, if you lose money, now you owe money to your brokerage. One of the things that has been really just keeping our economy alive right now are low interest rates, because mortgage rates are historically very low, and these low mortgage rates have been creating an insane demand for people to go out and buy a home. Now, the entire housing market is a very large industry and employs a ton of people, from real estate agents to brokers to home inspectors to contractors to title companies. And so we have a massive industry that is being supported right now thanks to the help of low interest rates. And the issue that the government and the Federal Reserve Bank are facing is they don't know how they're going to be able to raise interest rates without really hurting the economy. Because like we talked about earlier, our economy is still on shaky waters. We still have millions of people that are out of a job. We still have millions of people that are struggling to pay their bills. Yet at the same time, you have some people that are going out and buying massive homes because they can qualify for cheap and easy debt. And so if you raise interest rates, the risk that the government and the Federal Reserve Bank run is that people are not going to be able to go out and afford homes. Because one of the main reasons why people can afford homes right now is that although home prices are super high, debt is super cheap, so people are able to make the payments just because mortgage rates are so low. And so if interest rates start to go up, that could really hurt the growth of our economy, especially the housing market. And so the Federal Reserve Bank is really struggling on how they're going to raise interest rates. Like in the early part of 2021, we started to see mortgage rates really go up. But then when that happened, people stopped refinancing as fast, and people stopped buying homes as much. And so the Federal Reserve Bank immediately brought interest rates way back down. And so this is something you definitely want to pay attention to, because if you have super cheap debt, it keeps adding more and more money into the system, which further dilutes the value of our dollars. But at the same time, the Federal Reserve Bank and the government want to increase interest rates. And so you want to understand, okay, if interest rates do go up, how is that going to affect the economy? Because that means people will not be able to borrow money as cheap, and businesses won't be able to borrow money as cheap, which could really hurt the growth of our economy. And at the same time, we have a lot of speculation going on in the asset market, especially the cryptocurrency and the stock market. The whole idea behind this speculation is people are putting their money into markets, the cryptocurrency market and the stock market, not with the hopes of building long-term wealth or because they believe in the asset that they're investing in, but for the sole purpose of getting rich quick. Now, the issue here is, yes, you can make a lot of money very quickly by trading. Nothing wrong with that. But when you fuel this greed and speculation with easy access to debt, that's how you start to build bubbles, because then people start to get greedy. They think, oh, everything keeps going up, so I can make a whole lot of money. And so people start leveraging up their bets with easy debt. And this creates more bubbles because now people have more money that's going into the system. And now people keep thinking that nothing can go wrong because more money keeps entering the economy. And so if that happens, and then things start to turn around, now you have a lot of debt in the markets, and if things start to go down and you're forced to sell, now you're negative. Now people start to panic and to sell even more because now they don't have the money to cover their losses, and this can create a massive crash very quickly, because if people do not have the ability to cover their losses, then they will sell fast because they don't want to lose more money than they have to. That's what happens when people are emotional traders, because they get triggered and they make decisions based off of emotions, not fundamentals or finances. Because when you make decisions based off of emotions, the thing that you're looking at is how fast can I double my money? How fast can I get rich? Not do I believe in the underlying value of this investment? Because when people are looking at just ways to get rich quick, they're going to be buying the next hot thing. Whatever's on Reddit, whatever's on Wall Street Bets, whatever's on internet forums or TV or something that's going to gather the next wave of momentum. People just want to come in and buy because they're hoping they can find the next Bitcoin or Tesla before it pops. That way they can just sell it off and walk away with a quick profit. Now when you couple with that with cheap and easy debt, that's how you create bubbles. Now that you understand all of that, let's talk about number 5, what's coming next. Our economy right now is propped up thanks to the help of easy and cheap debt and free money by the government. Now, this is not very sustainable. We cannot live in a system where the government is going to keep sending out free checks to people, and we cannot live in a system where people are just relying on this free money in order to survive. Okay, so if you want to talk about the future health of the economy, because the economy is similar but different to the stock market, the thing that you need to understand about the economy is the biggest indicator about the strength of the economy is just the unemployment rate. Because if people have jobs, then they're working and they have an income, and now they have money to go out and spend money and invest and just live their lives. If they do not have jobs, then they have to rely on the government or someone else to take care of them, and that is a big burden for our economic system. So if you want to talk about the health of the economy, the easiest thing that you can pay attention to is the unemployment rate. And if we continue to see a very high unemployment rate, that is not good news for the economy, because that means our economy cannot grow because people don't have money to spend. Right now, people have been spending money thanks to the help of cheap debt and thanks to the help of the government. That is not a sustainable way to continue to grow an economy. If you want to grow an economy, people need to create this wealth themselves through their work, through their efforts, through the labor, and through the value that they create. If you look at asset prices, so stocks, cryptocurrency, real estate, the thing that determines the price of assets, especially in the short term, is how many buyers and sellers there are. And so if you look at the number of buyers and sellers there are, it's determined by how much money people have in their pockets. And for the last year or so, people have had a lot of money in their pockets thanks through the help of everything that I talked about. Government money and through this extra cash out refinancing that people have been doing. Because you have a lot of people, I know a couple of people that have done this, that have cashed out refinanced on their homes, taken all this new equity, whether it's $20,000 or $200,000, and then they took all this cash and they put it in the market. Now, it's a good thing for you to be investing your money. The risky thing is we have a lot of people taking this extra money and they're putting this money into the stock market or real estate, and so it's creating a lot of new buyers because people have this extra cash to buy. And so if you start to see these buyers start to dwindle because people have put all their money in the market, now you don't have the same number of buyers as before. And if you don't have the same buyers supporting the value of assets, that's what can cause the price of assets to go down, especially in the short term. In the long term, you have to look at fundamentals. You have to look at the economy. If the economy is not growing, if companies are not making money, if people cannot support housing prices, all these things have to correct. But if the economy is growing, then you can see the price of stocks and cryptocurrency and real estate continue to go up because people have money and people's income will hopefully grow and they have more money to invest. And so in the long term, you have to look at the economy to understand asset prices. In the short term, you have to look at how much cash people have access to, because the more cash people have, will determine how much people can buy assets. The first thing you can look at is the government. Because if the government doesn't pass out any more stimulus checks, and if you start to see these unemployment benefits go away, and if you see the government stop handing out free money to businesses and other industries, then that could limit how much more money people have to buy, because now they're stopped getting this free money unless people go out and get jobs. The second thing that you want to pay attention to is housing prices. Because if housing prices start to stabilize, or if they start to go down just a little bit, then people will not be able to cash out refinance the way they were before, which could limit the amount of cash that people can put out of their homes to invest in the market. And so if home prices continue to go up, and if you start to see the economy grow, or if you start to see the government give out more money through unemployment checks or whatever, then people will continue to have more money. And if people continue to have more money, now this cash can go back into the market. Now, ideally, you don't want to see people relying on the government. You want to see people working and earning their own income. And if people have an income, which means you're seeing unemployment rates go down, and if home prices keep going up, that means people will have cash to continue buying assets. And if that happens, you can continue to see asset prices go up. But if people cannot support asset prices because now their incomes have gone down, they cannot cash out refinance, they cannot qualify debt to continue buying assets, then that could cause asset prices to go down because you won't have enough buyers to continue supporting the sellers. Because what we've been seeing happen in the real estate market is we have a seller's market. You have a low inventory of homes available for sale, and you have everybody that wants to buy a home and capitalize on these low mortgage rates. Eventually, you're going to hit a tipping point where the amount of sellers are going to equal the number of buyers, and it will eventually turn around. When will that be? I don't know. Probably not in the next 6 months, but this will eventually happen. And when that happens, you will see home prices start to slow down. That doesn't mean they're going to crash, but they might slow down. They might not grow as fast, or they might even come down a little bit. But you have to understand that there is this market equilibrium that happens, but this has been kind of skewed through government kind of intervention. It's the same thing in the stock market. A stock's price is determined by how many buyers there are. If you have more buyers than sellers, the price of a stock will go up. If you have more sellers than buyers, the price of a stock will go down. And so if people have cash in their pockets, they can continue to buy stocks, and this will push the price of stocks up, especially in the short term. So if you want to understand what's going to happen in the market in the short term, you got to pay attention to how much cash people have in their hands. If you start to see the economy slow down more, and if you start to see people not being able to get access to more cash, that's when asset prices will fall. But if people have an abundance of cash in their pockets, some people are going to put this money in the market, which will push asset prices up in the short term. In the long term, the price of real estate and stocks is going to be determined by how strong our economy is. Because if people cannot afford their lifestyle, if they do not have an income, then they will not be able to continue buying stocks, and they will not be able to go out and buy homes. If that happens, the number of buyers over the long term will go down, which will cause the asset prices to go down as well. And so if you want to understand the long-term value of these things, you have to look at the long-term health of the economy. Now, the government is trying to do everything they can to help grow the economy and get the economy back to normal, but that cannot be done solely by the government. It has to be done by people. People have to want to go back to work, and as people go back to work, businesses have to reinvest in their growth, they have to hire more people, they have to invest in technology, they have to create new jobs, and if you see that happen, you can see the economy boom. If you don't see that happen, and if you see people continue to struggle getting jobs, and if you see people struggling to afford their lifestyles because the cost of living has gone up so much, then that can really hinder the long-term growth of our assets and hinder the long-term growth of our economy. So to answer the question, what's coming next? Well, nobody can predict the future, but now you have all the education that you need to know to understand what will cause what, and based off of that, you want to make smart investment decisions by paying attention to what's going on around you. If you enjoyed this video, here's a video on things you need to do to build wealth, and while you're at it, download a free money management PDF, and as always, keep hustling. We're going to be focusing on residential real estate today because residential real estate is the easiest to understand. People will always need a place to live. They're always going to need a roof over their heads. So residential real estate is recession proof and is pandemic proof.